Welcome to this video. Today we talk about documentary collections in detail. We'll try to get an understanding of the documentary collections. Documentary collections are also called DA or DP, documents against payment, documents against acceptance. Banks act as intermediaries to facilitate the exchange of shipping documents for the payment or promise to pay, that is acceptance. The acceptance can be a bill of exchange or an undertaking to pay. This balances the risk between the buyer and seller. It offers more security than an open account but less than a letter of credit. It is less costly than an LC and more costly than an open account. It is commonly used when parties have a reasonable trust but enough for unsecured transaction. How does documentary collection work? The process. The seller ships the goods and submits trade documents. The remitting bank forwards these documents to the buyer's bank, who is also called collecting or presenting bank. They present the document and they release the document to the buyer only upon payment by the buyer. The buyer is called drawee. Drawer, the person who sends the document, the principal, the shipper, is called drawee. So the documents will be released against payment means the document will be given by the presenting bank to the buyer only when they pay. Documents against acceptance means the buyer will present the acceptance of a bill of exchange, or the buyer will present an undertaking to pay and get the documents. So document release, document transfer, these are controlled by the documentary collection through the bank. The seller ships, the buyer pays or accepts to pay. The key documents are mostly shipping documents and sometimes financial documents. Financial documents is a bill of exchange. The shipping documents are bill of lading, proof of shipment and title to goods, commercial invoice, proof of sale, details of the transaction, packing list, contents of the shipment, how they have been put into container, and then certificate of origin for tax and other tariff purposes. The types of documentary collection, as you have seen, is against DA or DP, against acceptance or against payment. What are the pros and cons, the benefits and defects? For the seller, documentary collection ensures payment or commitment before releasing control over the goods, so it is less risky. For the buyer, it delays the payment until goods are shipped and many times documents are received. The cost is lower than the LC. Disadvantage is that the seller relies on buyer's willingness to pay or ability to pay because there is no promise from a bank, and it may cause delay depending upon the buyer's liquidity. In documentary collection, benefit from digital platforms via EBL or blockchain is also speeding up in some places, but again the dependency on buyer's willingness or ability to fund for payment or get a buyer financing to pay is what matters. It suits mid-trust scenarios and it is growing in many corridors. Asia-Africa corridor is well known for the use of collection as a payment method. Let us look at one case study. Suppose an African coffee roaster is ordering 750,000 worth of premium Arabica coffee beans from an Ethiopian exporter for delivery from Djibouti to Cape Town by April. The parties with a 2-year trade history opt for documentary collection DP due to moderate trust and cost efficiency, leveraging African Continental Trade Area AfCFTA. CFTA is the free trade agreement for the continent that provides benefits to different countries. Who are the parties involved? Exporter is Addis Coffee, importer is Cape Roast, freight forwarder is Ethio Logistics, bank is Ethiopian Commercial Bank, then Ethiopian Customs and South African Revenue Service are involved. How will the contract be settled? There is a 15 tons of Arabica beans to be packed in 250 bags valued at $750,000 sent FOB Djibouti. FOB is free on board. The risk transfers the moment goods are put on the ship. Settlement is DP, documents against payment. Cape Roast pays upon document presentation and claim goods. BL is to be provided, certificate of origin and then commercial invoice. How the transaction flows: in March, contract is signed, and then goods are shipped via Ethiopia logistics. BL is procured and presented. Invoice is presented for some 50,000. Packing list is showing 15 towns or 250 bag each weighs each sack. Then certificate of origin of Ethiopia is given. Then the Ethiopian Commercial Bank sends this document to Standard Bank South Africa, and instructions are sent that it is DP. Then shipment arrives in Cape Town. The party is notified. The party pays to collect the documents. Why? If they don't pay, the delay will cause damages to them. They will have to, the buyer has to pay customs clearance duties. But in this case, you have a African Free Trade Agreement for the continent. You have to only pay freight because this is FOB, and then you have to pay for insurance and local clearing costs. Standard Bank transfers the money to Ethiopian Commercial Bank. What are the challenges, if any, and how these can be resolved? Cape Coast will delay the payment due to cash flow or arrival of ship sometimes. Though it is DP, you have to wait because until the bank makes payment, the documents will not be given control to the buyer. Sometimes there could be error in the document. Invoice will list a 260 bag instead of 250. And if the documents are digital, it can be rectified. Otherwise, it will have rejection in the port or elsewhere. Sometimes there is a port congestion which will cause delay in unloading. But this is FOB, so the risk is transferred, and because it is DP, the payment is not made until the party accepts the goods. What is the outcome? The outcome is that 749,000 only you will receive because of the fees involved in between by the banks. Your cost as a seller will be for the shipment, not even for the shipment, because it is FOB. Cape Coast will pay for freight, local cost, clearing, and also any duties other than for free trade agreement territory rules. Because it is DP collection, only the bank cost will be the cost for the parties. The seller will get a security because Addis retains the control via BL. The buyer has the flexibility because Cape Coast can pay only after the ship arrives in their port. The insights that we get in this transaction is that there is the balance of the risk and the efficiency and the trust and the cost, and it limits the loss to either parties. Because if Cape Coast refuses the payment, Addis will suffer a resale cost. This is the risk of DP. But at the same time, had it not been DP, you would have never got the payment also, had it been open account or anywhere else. So specifically for DP, by using banks to tie the payment to the documentary release, it gives a practical, cost-effective settlement method based on the middle level of risk that the parties are having and middle level of trust that the parties are having. Thanks for watching this video. We will have another short session on another product.